Steven, this is the best stock in the stock market. You asked me last night.
Why are you gassing it up like that?
Because
yeah,
we need to get
dude,
people
you gotta
excited.
just let it be.
All right,
Jesus.
here you go, Steven.
Oh, so
You
we're not
got-
guessing. I guess
we
we're
got
So-
15 minutes on the clock. Tell us why this is the best stock.
All
in the
right,
market.
so I scrapped the name. I'm going to try not to say it and screw this up. I saw somebody come on here and pitch you guys a stock, and all they did was read from the slide deck. Promise you I'm going to do a little bit of a better job than that. So this company generates a ton of money last quarter, and they do not report on a calendar year. That's why it says Q3 right now. So in Q3, they generated 14.6 billion revenue, and they made billions in net income. Go to the next slide.
What was the net income?
I'm showing you right now. So in Q3, they generated 3.2 billion net income. They had 6% year-over-year growth in it.
By the way,
This
net
is a-
income means profit, correct? That's $3 billion in
Yeah, unlike you, who said in a freaking debate that gross profit goes to the bottom line.
Yeah, I meant to say adjusted gross margin. Dan, you're killing me on that. I meant to say adjusted gross
Net
margin.
income is your profit after taxes, write-downs, everything is your
All right,
net.
fine. Continue. Goodness.
Okay. So this is an older company, but it is still growing. 14% year-over-year quarterly revenue growth. Went from 12.8 billion last year Q3 to 14.57. So there is growth. Go to the next slide. And Carlos, I'm going to answer your rhetorical question. There are no headlines. Nothing for you to get excited about.
Nothing
So
to get
there's
excited
no headlines. So
He loves that question. That's how you know he's a fan of the show. He loves that
It's a
question.
great question because he's right. A lot of market is based on sentiment. So, all right.
Can you just pause on that one for a second? Okay, 99. We had a run up at a massive
Yeah.
run up at
So
99.
this is a company that's
It's an
never
old
gone
stock.
back to the .com highs. So this company went parabolic in the 2000 run. 23 years later, has never gone back to that. So now, next slide, please, Amit. Even though they've never gone back to their .com highs, they have grown a tremendous amount. So I put the 2000 fiscal year numbers versus the 22 fiscal year. And over that 22-year period, they've grown their revenue by 172%. They've added 32.64 billion in revenue.
That's not a lot.
For annual revenue, it's a 7.84%.
But it's been 20
annual.
years. It's been 20 years.
A lot of money.
Grow at 100%.
A lot of money. So their gross profits grown by 164%, net income 342%. So go to the next slide. So we'll maybe be able to put this slide deck somewhere so everybody can grab it. So I did all the calculations here. You can go to the next one. So over the past decade, this is a company that's generated 548 billion in revenue, 103 billion in net income, 156 billion in cash from operations, and 146 billion in free cash flow. Revenue's grown 12.94%. I'm not going to go through all the numbers.
That's per year, right? That's per year?
No, that's
Yeah.
over 10 years, right?
10 years. So this is a company that knows how to make money. They're huge free cash flow positive, and they've allocated 55.31 billion to dividends and repurchased 84.83 billion in shares. They've actually repurchased about 24% of the company over the past decade. So if you go to the next slide, I made a chart showing their annual revenue, gross profit, net income, and free cash flow. Very slow trending line up, but it is very consistent. Cash flow machine. All right, go to the next slide. This is on a quarterly look since October 2020 of those same thing, uptick a little bit more now because they've diversified into other areas, and we'll get into that after I say what stock it is. So balance sheet is a fortress. Go to the next slide, please, Amit. So they have 8 billion cash on hand.
Damn.
Just over 15 billion in short-term investments. So they have just over 23 billion in on-hand liquidity. They have 1.73 billion in debt due within the next year and almost 29 billion in total long-term debt. So they have almost enough cash on-hand liquidity to pay off their long-term debt.
What does 15 billion in short-term investments mean? What do you mean?
T-bills, that type of anything that can be liquidated with that doesn't have a maturity of a year or over. So if it was under long-term assets, it would be anything with a year or longer duration. So fortress balance sheet. Go to the next slide, please. So dividend stats. I like dividends. I like income. So the first quarterly dividend was paid April 20th, 2011.
420.
Shares were 420. So shares were just about $21 at the start of 2011. Since then, they've paid $13.10 in dividend income, which is roughly 62% of the share price at the beginning of 2011. 11 years of consecutive dividend growth, quarterly dividends grown by 550% since then, and the current dividend is $1.56 annualized, which is just over a 3% yield. And based on the forward 2023 EPS projection, it has a 55.14% payout ratio. So there is a ton of room for dividend increases in the future. Next slide, please. So
I think I know the stock, but
Okay, don't say it. We're gonna ask you right at the end of the presentation.
yeah, there's 3 more slides. So buybacks, they had about 5.4 billion shares outstanding at the end of 2013. As of the latest report, just over 4 billion. They have repurchased 1.3 billion shares over the past decade and taken almost a quarter of the shares off the table. So the graph on the right I made, which has blue is your common shares, and then in red is how much they took off the table each year through buybacks. So every year they are buying back shares. Next slide. So there is growth. The analysts are projecting 13% year-over-year EPS growth this year, and another 6.5% in 2024, and then another 5% in 2025. Not huge growth, but when you're generating the type of revenue and net income that this company is, it's substantial. So here's where things get very interesting. The last 2 slides, the valuations. I'm a numbers geek. And when you see this will, Carlos, explain to you why I had a hard time investing in Tesla. So this company is at the top. It has no name. I whited it out. So right now, I like free cash flow as my number one metric for profitability because it's cash in versus cash out. Net income, you have taxes, write-offs, everything else baked into it. So I think free cash flow is a little bit more of a pure number. So this company trades at $50.80 a share. Its free cash flow in the trailing 12 months is $16.8 billion. It trades at 12 times free cash flow. Its forward 2023 PE is 13.33. And based off their 2024, it's not Bitcoin. On 2024 numbers, it trades at 12.5 times. So I put in IBM, Broadcom, Alphabet, Apple, Adobe, Salesforce, Meta, Oracle, Microsoft, Tesla, AMD, and NVIDIA in here. And you look at the old guard tech, they're trading, 13 to 30 on price to free cash flow. And then there are some really big numbers on newer, more popular companies. Forward PEs are across the board. So you go into the last slide. I took NVIDIA, Tesla, and AMD out because they had very high price to free cash flow. So I wanted to make it more in line with old guard tech. So the average free cash flow multiple of the old guard tech is 28, about 29. So when I assign a 29 multiple to this company's free cash flow, they look 135% undervalued. Whereas an Apple right now, based on this methodology, would be 2% overvalued. So I have different ways of looking at things. This is one of the ways that I look at things. And this is kind of like, it's not the end all be all, but if a company is within a range of where I think it's undervalued, I'll do more research and due diligence. This is kind of my baseline if I'm going to really put the time in to look at it.
Okay, so Vitaly and Carlos, what's your guess?
Do you have any guesses, or do you want me to tell you what business on IT they're in first?
No, I mean,
they're in IT?
It's an IT company, yes. I'll give you a hint. So
no, let's get the raw guess. Let's get the raw guess. Vitaly,
Okay.
what's your raw guess?
before the stock price, I thought it was AT&T.
Okay, so what do you think it is now?
Well,
I've seen that dividend chart, and they also had the same deal. They ran up a lot in the 90s, 2000 because of the internet was going to be a thing, and it was like, oh my god, and they were laying the pipes. They were going to be the foundation for this new thing called the internet. But no.
So you're going with AT&T? That's your final answer?
No, because it's not. The stock price is $15.
Well,
so
I cheated and I asked Bard.
Oh my god!
I love that.
You ruined the game.
Shareholder of Alphabet. I love that.
I can't use Chat GPT. I don't have enough Microsoft.
That's the best line. You got to tweet that. That's the best. That's the most capitalist investor thing I've heard.
I basically
ever.
followed this guy, dividend streams here, when he talked about oil.
No, I mean it's gotta be Cisco.
It's Cisco. Yeah.
You guys, you really think it's Cisco? That's what you think it is?
What do you mean? Bart said it was Cisco.
What do you mean? You're supposed to play along with me. We're supposed to make them feel like they don't get it, and then we're supposed to.
No, but
you shouldn't have told us the stock price. Until I saw the stock price, I was like,
the stock price gave it away.
Because here's the deal: you're describing AT&T as well. You know, they've been beaten up for describing AT&T a lot.
The problem, all the growth, you know, is Cisco. I mean, they're growing slowly, as you pointed out, but like, I think people priced in that's it. Their growth is sort of over, right?
It's a boring company. There's no headlines, but it is so undervalued based on where everybody else is. And this is a company that's generating tens of billions of dollars in pure profit, and they're no longer just a hardware company. So they're no longer just selling switches, firewalls, access points. They're in cybersecurity, and they have, I think it's around 25 or 30% of their business is now subscription model based with software. And they are seeing another line of growth due to those recurring revenue streams. And with the amount of capital that they are allocating toward buybacks, even the low growth, they're going to keep taking shares off the table, and their EPS is artificially going to get inflated because now their earnings from operations are going to get distributed across fewer amount of shares, causing EPS to continue to go up. And they've already said that they are committed to allocating cash to shareholders through buybacks and increasing the dividend. And they generate a ton of it with pretty low CapEx.
Okay, Steven, I want to get your reaction to this comment. Up 14% in 5 years. The question marks imply that that's a horrible growth rate. What is your kind of response as a more of a value investor to this comment?
Oh, people like to say I'm a value investor.
I mean, I know you're not a value investor, but like,
yeah, look, the first thing I said, it's not going to grab headlines. It's not a Tesla or an NVIDIA or an AMD or even an Apple or a Microsoft. Okay, it is a boring old company, but the market could go into a rotation into value at some point. And there are two companies that are going to look really interesting. And AMIT, I said at 128 to you and Chris in a private text, IBM's going to look real interesting. What's it at now? 138 in like a week?
Is it?
Yeah, because
I don't follow IBM because it's fucking boring. So like,
it's boring as hell, but it makes a lot of money.
I think you're making a great case to have this in your portfolio, right? But
it's a value trap, just like
I mean, I don't know that
it could be.
It's going from what you're showing now. If the things stay the same, you're showing a trajectory for continued growth. And for me, the dividend says everything. As long as they continue to pay the dividend and I keep growing my money, if it's not capital appreciation, if I just keep getting more shares and getting more dividend, I don't give a shit. The problem is I don't want to say the problem because that's an incorrect assessment of what I feel like you're doing is you're making a very left-brained argument. And I'm trying to think of an analogy that could make this make sense. Okay, say you're a baseball coach. You play baseball?
Used to.
Okay, so you play baseball. You're a baseball coach and you have a guy that's on your team that's a switch hitter. Okay, now a switch hitter is going to have a dominant side. So, but if you look at just their batting average, it doesn't quite speak to the value that player brings your team, because they can be put into situations to counter different pitches. They might have a better on-base percentage one side or the other. And so I feel like looking at the price to free cash flow as like the metric that says this company is 138% undervalued is the same as looking at a switch hitter and saying, well, look at their batting average and they're not as good as, say, the guy, if you're in the American League, my DH, right? But there's other metrics that you have to weigh in when you consider as a coach how you use that player, and in the same way how you allocate your capital. So yes, on that one metric, they're incredibly undervalued compared to a company like Apple. But now that we know what the company is, what Apple is doing and what Cisco is doing are vastly different things, right? And so I think they do
completely different,
and that's why I think they will have different multiples based on what you're based on what metric you're looking at. Oh
yeah, and look, Cisco's never going to be an out front company that people get excited about. That's just not going to happen. I don't know if Cisco will ever trade at more than a 20 PE. It's just, it's one of those stocks that has been forgotten about, written off. But it has been a very large generator of capital, and they're reinvesting into other areas. And
But not for its
from
shareholders, to be clear, okay? Because it has not done well in 20 years. And here is something I used to not look at in Seeking Alpha. Now that you can actually go and check out, okay, so you're like dividend scorecard. Oh, that's great. The safety is a B minus. The growth says an A. But then you look at the actual statistics, and here, 1 year dividend growth rate, 2.68. What was inflation this past year? So
Almost
sector
9%.
medium is 8%. So if you're talking about this is a great way to grow capital, you should just look at what is the current inflation? Are they beating inflation even with the dividends? They're definitely not beating it with stock appreciation. So here you have something that is under inflation. That means it'll never catch up. They're actually losing you money every year, even if they're paying you a dividend.
Steve,
And
what's the response to that? What's the
Hold
response
on.
to that?
And I made a similar
Well, let me finish.
mistake. I made a similar mistake buying AT&T and Verizon because of the bigger dividends, but not looking at all the statistics around that dividend. So I similar thing, and I'm bag holding those as well.
Me too. Me too. And I think we both have Cisco in our dividend portfolio. We have Cisco. We have Verizon. We have CVS. I do have CVS. I have some of these companies that we're talking about that aren't necessarily exciting companies, but I find them as a good place, a good safe place to park some capital. And I don't think that you should be in all growth stocks all the time. I don't believe that either. I believe that there's a certain percentage of your portfolio that should be in somewhat safe growing companies.
Yeah, so
But I think you're making the case. I think you're making the case that this is like some sleeper that's about to it's about to go.
And I'm not saying it's going to pop. I'm just saying that this is, to me, a sleeper that continues to grow, that pays a very good dividend. It is rewarding shareholders through buybacks, and it keeps getting cheaper and cheaper. And look, if you go back to one of the first slides that had the price, if you take that big pop in 2000 out of it, it's been a gradual increaser, and it's not going to do what it doesn't have the potential to do what Meta's going to do, or one of those.
Forget about Meta. You could have bought Costco. That's an actual growing, and they're growing their dividend like 15% or something. So
Costco's dividend's a little low for me, though.
No, that's right, because you're chasing the yield and you're not actually looking at the growth.
I should disclose how I invest.
By the way, I don't have Costco anymore. I did sell out of it, but still, that is the better value play if you were to play it. Not currently, but that is the better value play.
So I have different baskets for my investments, and I have tech side.
So what basket does Cisco go into, and what are the metrics or the parameters that determine what goes in that basket?
So Cisco is in my dividend growth side, because I feel that they have the potential to continue to increase dividends at a higher rate going forward, because there's going to be less places for them to put cash. There's not many
higher yield.
Yes. Well, if the stock price keeps going up, the yield may not increase, but the annual dividend will keep increasing, because their 5-year average growth rate will probably keep growing.
Mm-hmm.
But it's one of those places that I'm looking at for that reason, and because if value comes back into favor, this is a value name that could get very interesting, because it is a tech name that has been left out in the cold.
It's a tech name. Also, IBM is a tech name. These aren't the real tech companies you want to be invested in at all.
That's the backbone. It's not going to go away.
That's when I invest in a real.
Steven, you want to disclose you use a crap ton of their products as well.
I don't want to talk about it.
But the fact that you do have experience with the products.
Well, look, my buddy is in IT sales. This is what he does. Okay, he's one of those guys. He's a sales guy, and all he sells is Cisco systems. And we talk all the time. He does $70,000, $100,000 systems, and he works on commission. So he's pumping these things.
I know a lot of people with
these giant cards for servers, all the phone systems that you need. Like, especially if you're in New York City and you need to outfit one of those buildings to do any sort of business. What do? They call up his company and they just come in there and they outfit your entire company with Cisco systems. They're sort of like picks and shovels in terms of the tech space. They're not really like Apple tech, but they're like the picks and shovels where you need them. It's kind of like your Dell computers.
So look,
like you need their infrastructure. If
you are building out an office, okay, there's not many options for your networks. So if you're going to build out a 200-person office, you need 200 drops, which are wire drops for the desktops. You need in your server room, you need a bunch of 24 and 48 port switches. You need your firewalls. You need your access points for the internet. You need your cabling. That's the backbone.
Yep.
Then you need software for cybersecurity, and then you need networking software so you can see what's down, do all your traffic admin and everything else. Cisco does the trifecta of the three.
Yeah.
And as long as we have offices, companies like Cisco are always going to have a part in the tech world. Cisco's competition is ubiquitous, a couple other companies, and Cisco is the crown jewel of the networking space. Their Meraki product is arguably one of the most sought after in the networking world. And like I said, they diversified into software for the very reason that they realize that they can't just live on hardware, and they're making more and more money. So with the amount of...
That's a piece of information. Is that
Yeah,
true?
I didn't even know that. But yeah, the AI thing, I'm not too familiar with what Cisco's going to do on cybersecurity with AI. I'm sure there's going to be a component of that, so I'd have to look into that also. But this is something that generates tens of billions in net income a year, and it's an established company, and you could get analyst chatter over it. And for a long-term stock, it'll probably keep going up slowly but surely. And look, I don't need to hit a home run every time. And that's why I like Cisco right now, because I think it's undervalued.
And now we all have a share of Cisco.
To
And
use
now
a
you all
baseball,
have a share of Cisco. They'll pay you dividends every quarter.
to use a baseball analogy, it's a slow 5-year home run. Like you're running in slow motion around the bases.
Oh, it is.
Now, Steve, what if I take your $50 and I buy a couple shares of Palantir instead? Would you want me to do that, or do you want me to buy?
No.
That's messed up.
It's messed up.
So I have to buy.
Well,
I think we
giving you each a share of Cisco.
Listen, I'll
Okay,
take
all right, I gotta buy
a share of
Cisco then.
Cisco. I have no problem.
I would only do it with your
Listen.
blessing to let me go buy something that's actually growing.
Do you want me to buy you a share of Palantir or buy you a share of Palantir?
No, you don't have to do that.
No. I think the point is you need to, it's for your own good. This is a prescription. Okay. He's coming in. He's the doctor. He's like, I'm looking at your portfolio. What you need is something that makes money. Okay.
All right.
He's prescribing you a dividend stock and you got to take your medicine.
Look, it's not the worst thing in the world, because I have
Yeah.
at least a similar belief that Intel, which is beaten down similar to Cisco, I feel Intel is like completely undervalued. And 2 years from now, we're gonna regret not buying Intel. If they do what they're supposed to do, come to America, use the CHIPS Act to make their own factories, to now sell their chips to everybody and become closer to a TSMC. So is that not worth more money in the future if they can do that? Of course it is. So,
and don't forget, they're going to fabricate for everybody. Everybody's going to use them. They're going to fabricate for everybody. And it's not just about selling Intel chips. It's about now your supply chain is domestic, not international. So you're going to have AMD go to them. You're going to have Apple with their M chips go to them for a portion of it instead of just Taiwan Semiconductor. It is,
if Apple comes back to Intel, that'd be quite a score.
Why would Apple ever come back to Intel?
I don't think
they're going to make chips for everybody.
It doesn't have to be CPUs. It could just be basic system controllers. Or
I think they'll fabricate for them, but I don't think they'll do the chip design.
No, that's what I mean, fabricate.
Okay, so then yes, I agree. But look, Intel was something that I really liked a lot, and then I got mad because they cut the dividend. But they did. It's the same thing as other companies, but they did it for the right reason because they're investing in the future. And look, we're never getting away from microprocessors. Everything has a microprocessor, and Intel's one of the only games in town for it. And here's the other thing: computers run on x86 chips. There's only two companies. ARM's not a company for x86. It's Intel and AMD. If you look at the gap between the two, I think Intel still has 75 or 80% of the market. And then on servers, I think they're 90% or more. I haven't looked at this quarter's stats, but there is a site, Passmark, that has the chart. So I can look at it later. But Intel is a sleeping giant. If you have time on your side, there's no reason it can't go back to 60 or 70 if you have 5 years.
60 or 70. Wow. Okay.
Well, I'm not saying overnight, but the next.
I know. I get you. It's been stuck at 30 for so long.
I was actually saying 100. That there's a bull case to be made. Intel go.
Yeah, I think there is. Because how much revenue can be brought in from the fabrication side? And it's not just one plant that they're making. So that's the other thing you got to think about.